Right. I am showing that we are at 12 o'clock Central, so I'll officially kick things off and say good afternoon and welcome to this session in the 2025 Yellowbook training series. I'm Rachel Windett with Sikich University, and I'll be on to support you all today. We also have Rachel Hawley with us, and she and I will be screening questions and comments as they come in. For CPE today, we will have 3 polls. As they come up during the session, please make sure you complete all 3 polls for CPE. If you're joining us via browser, make sure you are set to full screen, as sometimes these polls can be hidden. You can expect that CPE certificate within 3 to 5 business days. This recording will be made available on demand in a few days following the event. An email will be sent with that information. So for this session, we welcome back our Master Yellowbook facilitators, Matt Geerdes and Anthony Cervini. Matt Geerdes is a principal with us. He's been a public accounting leader for nearly 24 years. He's provided auditing and consulting services and works closely with entities in the local government and NFP sectors. Anthony Cervini, also a principal with us, is our local government audit leader. He has participated in hundreds of audits in municipalities and other governmental entities since the beginning of his career with us in 2005. So without further ado, thank you everyone for joining us, and I'll hand it over to our facilitators.
Thanks so much, Rachel, and thank you everyone for taking time to join us today. We're excited to have you hopefully joining us on a continuing basis here for our Yellowbook series and information that we're trying to present relevant and meaningful information for you from the GASB, what we're seeing in terms of implementations and going through some of the many standards that the GASB has issued there. As Rachel was going through the introductions there, all I could think of is how much hair Matt and I had when we started our career with all the GASBs going out there. So, but and we find ourselves here today. So again, thank you for taking the time. Again, our contact information in the slides there. If you have questions after the fact, certainly feel free to reach out to either myself or Matt. We're always happy to connect and address any questions that do come up during the course of today's session. If you do have questions, please feel free to submit those as well. If we do have time, we will try to get to those as well. From an agenda standpoint, we'll highlight just a few things here for you. Obviously, the GASB has been very busy, as we know, over the last several years, pretty much I think since Matt and I started our careers. It seems like the GASB has been busy with pushing out new standards or guidance. And so what we're going to do today is focus on some of the key information that we've seen in recent years in terms of that, and looking at the implementations of GASB Statement 100. We'll talk a little bit about GASB Statement 101 on compensated absences, Statement 87 and Statement 96, the statements on leases and subscription-based information technology arrangements, or SPIDAs. And then finally, we'll cover just a hodgepodge of a few other topics there. And then if time permits, if you do have questions throughout today's session, obviously we have left some time at the end to hopefully be able to address some of those for you as well. So with that, we're going to go ahead and launch our first polling question of the day. So we'll give Rachel a second to get that launched for you here for our first poll.
Right, so that poll is launched. Who prepares your entity's financial statements?
I personally like answer number 2, but that doesn't always work. So, although we're getting a fair amount of people responding with that question, so that answer, that's pretty cool. And you mentioned too about when we started, how much hair we have left, or how much I don't have as much as I used to have. So I think when I started my career, we were a GASB 32, I think. That was like the first one I think I can consciously remember. So
yep, it was I think back to looking at GASB 40 on cash and investments and the statistical section here. So definitely some interesting ones there. So we have about 95% of our vote in, 45% of our respondents indicated that the auditors prepare, but they're doing certain sections in-house, 24% preparing the statements in-house with no outside help, separate provider for 11 or 5% of our respondents there, and then 65% folks, or 27%, who are not associated with financial statement issuers there. So always just an interesting snapshot for us here to see, how folks are preparing their financial statements ultimately as those of you that are, with an entity and prepare financial statements, that those are your responsibility. And then even if the auditor prepares those, you still have to understand and accept responsibility for that. So at Sikich, as part of our Yellowbook series, as part of this session today, our goal continuously being able to educate you, whether it be through these sessions, through the thought leadership pieces that we publish on our social channels, on LinkedIn, or on our website there. So again, if there's topics or questions that you have that come up during the course of, you're looking at standards, you're looking at your financial statements there, by all means, please reach out to us with those. We try to make these as relevant for you as we possibly can. So with that, we're going to move into GASB Statement 100. GASB Statement 100, covering accounting changes and error corrections. So for GASB Statement 100, again, this was looking, the GASB looked at guidance that have been issued there and really came to the conclusion and determination that while the guidance was all there and the guidance was clear as part of that, it really wasn't necessarily aggregated into kind of one concise, cohesive location for folks to reference as part of that as well. So that was part of the onus for GASB Statement 100, as well as some amendments that were made to that there. Again, just it was time. It was time to look at this. It was time for GASB to do this. This is effective for fiscal years that began after June 15th of 2023. So while earlier application was encouraged for that, pretty much it's go time for all of you if you haven't already implemented Statement 100 here. So what Statement 100 told us is that there were 3 types of accounting changes that we could have, and then our corrections of an error here. So terminology-wise, we used to refer to things as prior period adjustments. We've really seen that terminology go by the wayside under GASB Statement 100. So the 3 types of accounting changes that we can have, as a refresher here, are changes in accounting principle. This is when we're implementing a new standard. So many of you may have gone through with the implementation of GASB Statement 101, or maybe going through that as we speak right now for the implementation of the compensated absences standard there. So that would be a change in accounting principle there. Change in accounting principle guidance tells us we, again, restate opening balances of net position, and for those, if those are material for your organization for that. Again, retroactive reporting in terms of that. Changes in accounting estimate are the next type of accounting change we can have. As a reminder, changes in accounting estimate are handled on a prospective basis here. So if we have a situation where perhaps we change a useful life on a depreciable asset there, that's an estimate in terms of the useful life there and how that is being depreciated. So that change in accounting estimate we handle on a prospective basis. And then finally, the one that I think caused much consternation, we'll talk through a little bit more detail here, more confusion, questions on this, was a change to or within the financial reporting entity. Many I think thought when the standard came out, they said, oh, well, I'm not, generally we're not in the business of adding or taking away component units on a regular basis there. But there were some other pieces here that factored into that. We'll cover those in just a second. The final piece that we can have that falls under GASB Statement 100, though, are our error corrections here. So previously issued financial statements, if there was a material error that warranted a restatement of those financial statements, we're now required by the standard to report those as corrections of errors and disclose those in that manner. But for purposes of today's session, we're going to talk a little bit more about changes to or within your financial reporting entity. And as you can see here, there's really 4 paths that we can look at in terms of when we have a change to or within that financial reporting entity. First being if we have an additional removal of a fund that results in the movement of those continuing operations within the primary government. So that can also include blended component units there. A change in the fund presentation as major or non-major. We'll talk more about that one here because that's really the one that is going to likely have the most impact and the most reach from the standard in terms of impacting your financial reporting. Additional removal of a component unit. This does accept and carve out acquisitions, mergers, transfers, etc. there, and Statement 90 component units. And then finally, a change in presentation of a component unit. So if you're going from a discrete presentation to blended or vice versa in terms of that. These are all the categories or all the types of changes that would fall under this changes to or within the financial reporting entity. So it's really that second box that we look at on the bottom row there that tells us, okay, when we have a fund that is changing from presentation as a major fund to a non-major fund, or vice versa for that, we have these new columns that we have to include and we have to present as part of that. And this is where, for those of you that participated in any GFOA training or have seen GFOA's timely accounting updates, or timely accounting discussions there, this is where this concept of a ghost column comes into play here. So if you think about your financial statements historically, if you had a fund that changed from a major to non-major fund or non-major to major fund there, ultimately there would be there could be situations, and there were situations where, totals on the ending financial statements for your prior year versus the opening balances may have been different, particularly in that non-major governmental funds column. If we look at that here, certainly could impact non-major enterprise funds as well, but we're using a non-major governmental presentation, for example, here. And what GASB tells us is that, instead of just adjusting the opening balances there, but not directing a financial statement reader to that, we're going to have these columns that we use to show those amounts there. So we're going to show those opening balance adjustments there. So you'll see here on this example, we have the fund balances as at the beginning of the year, as they were previously reported. We then have the adjustment moving from the major fund to a non-major fund. So what we've done is we've presented no activity during the course of the year outside of the opening balance, and then the reclassification of that balance from a change in the reporting entity or change within the reporting entity. So we're moving it from the South TIF, which we've noted as formerly major, and then moving that into the non-major governmental funds, and then bringing us to a restated or adjusted fund balance there for both of those funds there as well. So that column in the middle, the boxed column, the South TIF, the formerly major fund, that is our ghost column, if you will, under using that GFOA terminology for it there. We've then adjusted that. Now someone can look at the current year financial statements as well as those prior year financial statements to see how those amounts are essentially transferring and moving from one year to the next in terms of that. Now, when you look at this, you also want to remind yourself, well, what is a major fund? How do we determine what a major fund is, and what classification can we, do we need to meet for something to be a major fund? So major funds, a few kind of hard and fast rules that we consider and look at as part of these. So your main operating fund, so the general fund or its equivalent, should always be reported as a major fund. Major fund for the general fund here, oftentimes if it doesn't require to be reported in another fund, then the general fund is often the landing spot for that there. So when we have other individual governmental or enterprise funds, they may meet the criteria for reporting as a major fund, and there's set criteria that we have to look at to do those calculations. So this quantitative component to the calculation here involves total assets, looking at total liabilities, looking at total revenues, and then looking at total expenditures or expenses of that individual fund, and determining whether those totals for the respective fund are 10% of the corresponding totals for the fund categories there. So for governmental, for enterprise, looking at those separately. So if we meet that, that calculation, we hit 10%. We're not done there. It's not automatically a major fund. We have to then go through the second part of this calculation and say, okay, well then does that category, and we're looking at these individually. So we're looking at assets, looking at liabilities, revenues, and or expenditures or expenses. Do those then meet 5% of the corresponding total for those funds combined for that there? Now, when you have both of those criteria, both the 10% and the 5% criteria met, congratulations, you have a major fund. Again, total assets 10%, more than 10%, total assets more than 5%, major fund. Same thing for revenues, liabilities, expenditures, expenses, that categorization meets there. Now, for those of you that have heard me present before, what's a GASB without an exception to the rule for that? So with major funds, you can always choose to present and elect to report a fund as major for that there. Generally, you may, you want to talk to your auditor about that because it does require some additional work in terms of that if you're not meeting the criteria there. But let's say you have an example of a fund, maybe a capital type fund that maybe in the majority of years it does quantify and calculate as major. but for whatever year you delayed capital projects there, doesn't calculate as major, but you have every expectation that it's going to go back to being a major fund on a regular basis there. You can then go through and elect to report that fund as major. You have to disclose that election within the report there, again, but you do have that option to be able to do that. So from there, we're going to go to our second polling question. So we'll go ahead and launch our second poll here.
All right, that poll has been launched. If a fund changes from major to non-major between fiscal years due to the 10% to 5% test, the footnotes require an explanation. Is this true or false? I'll give everyone a few more seconds. Okay, I'm going to close. And 77% say this is true.
All right. So this was a bit of a trick question for you guys here. This was a tricky one in the sense that a description of said change is not really required when a fund, a fund not calculating as major or calculating as major is the only reason for that change within the financial reporting entity there. Now, there are still disclosures required to show those amounts there, but you are not required to explain that per se there. Now, again, are you in effect doing that by showing it? Probably. So kind of gets to semantics there, but not a requirement there, whereas the other types of changes under statement 100 or the error corrections that fall under that do require that specific note disclosure there. So with that, I'm going to turn things over to Matt to talk about GASB 101, our favorite standard on compensated absences.
Yeah, you got that right. This is a standard that, as we're, in August of the implementation year, we're, the 12/31/24 engagements were the first one up for the implementation cycle. And, now I said we're also getting into, 3/31, 4/30, 6/30. So yes, this is now that's out there. We had a couple, of course, early adopters. So, there were a couple of common things that we've seen in practice that we wanted to bring to your attention, and a few just had things to think about as well. And what we've done is laid these out into four, essentially categories of what we were seeing. Improper assumptions, specifically with sick time usage, because really that's where we were seeing the most challenges, was dealing with that sick time. Just because, of course, vacation, when it comes to settlement, that usually is going to be almost 100% settled either in cash or it's going to be used. So not really an issue there, but you still could. The inclusion of salary-related payments is another typical error we've seen. Just was dealing with that this week on a client. So it does happen. So perhaps maybe it could be an improper type of estimate based on the facts and circumstances for classifications of employees. And then, of course, missing disclosures as well. So even though, Statement 101 did tweak some of those disclosure standards and took something out, there are some things that do need to be included with this standard. So we'll talk about that during our time together. So what I've done is these next couple slides kind of laid out some fact patterns with basically what we were seeing was driving the problem. And we'll talk specifically about what the root cause was. We'll talk a little bit about what GAP is actually citing, then saying, yes, you need to do this. And we'll talk about some fixes and some things to be thinking about as well. So now we're not going through every aspect or facet of the standard here, but this one and also some of the other ones we're going to talk about a little bit. So, we're obviously just going to keep this kind of narrow just because of the fact that, everybody's facts and circumstances are going to be different and the scenarios they're seeing are going to be a little bit different. So, all right, so this first scenario is that we're going to assume that in our sick bank, 50% of the accrued unused sick time is going to be paid out via at termination or retirement in cash. So that's the first piece of settlement we got there. Second thing is that we're going to assume 5% of the bank, of the balance that employees have, 5% of that is going to be converted into some sort of, in this case, defined benefit pension service time credit when an employee actually retires. In the state of Illinois, Illinois Municipal Retirement Fund is a common example of that. So the issue is that our calculation accrued the sick time and says that all of it's going to be used or it's going to get paid out. So therefore, whatever we got in the bank, hours times rate, that's our compensated absence liability. So obviously that's not 100% correct. And, really just driving down what kind of is causing that is that, really it's an inadequate understanding of the settlement. And if you see on the right-hand side of the slide, the GASB citation for 101, paragraph 9, talks about the three things that talk about. One, what is settlement? Is you have to make sure that it's attributed to services already rendered and it accumulates. So 1 and 2 were there. More than likely, time going to be used off in cash or settled through non-cash means. So you can't just blanket assume that it's all going to be there. So it's all going to be met. So you have to think about those settlement pieces and what falls into your criteria. And then paragraph 13 specifically calls out that if a facet of that settlement is conversion into a defined benefit, very specific, defined benefit, post-employment benefit, we're not calling that a compensated absence liability under 101. The reason is that's already under 67 and 68 and 75 for pension and OPEB. So the actuaries are picking that up. We don't need to double dip that liability. So because of that, then, well, how do we fix this here? So, I've included some suggested corrective actions on fixing a scenario like this. And well, the first thing is, of course, is just one, you really do have to understand what is your historical usage. What are people going to use over a select period of time? So, and, GASB, again, was very specific to not include this is how you calculate this liability. It has some big guidelines. When it comes to the usage percentage, they left it very deliberately open so that it's unique to your individual entity's facts and circumstances. So, it might be relative for 3 years, maybe 5 years, maybe 7 years. Maybe 5 years in the current state of affairs is not the appropriate one because, 5 years ago, you're into 2020. Well, that was during the pandemic. Is that a real accurate reflection? Maybe, maybe not. So you need to be thinking about that as well. So the next thing is looking at also what is your historical conversion? What are people actually converting into defined benefit, other post-employment or pension for your usage? Basically getting that same type of breakdown as the regular usage. And then the first step would be is determine your accrued sick time that's settled via your anticipated usage. It could be the percentage of time used divided by the time earned in a single period or the time earned to date. Again, no set approach is required by Statement 101, but of course it has to be documented and it has to be reasonable. So, and then the next piece of this calculation and this suggested action is determine the accrued sick time converted to your defined benefit pension service credit. So very similar to how that's settled. So once you've figured out those buckets, then you can determine what your liability is going to be. Now, then what you do is actually calculate the liability. So your accrued sick time versus the, multiply that by your cash settlement usage. So we know how much that's going to be. Okay, that's one piece of the liability, plus the usage time credit for what people are going to actually use. So let's say it's 5% here. So we're going to have 50% plus 5%. That's your total compensated absence liability for sick time on the hours. Now I have to remember salary-related payments, which we're going to talk about next. This has to be included in here. But for this example, we just did the compensated absence liability just on the sick times the hours times the rate. So now keep in mind, this formula is only including the amounts to be included. So the conversion to defined benefit benefits is naturally going to be excluded. So you don't have to actually bake it into this formula. However, if the approach you want to take is taking with your total accrued unused sick time and then backing out the amounts that you should not be including, that's when that conversion to defined benefit, that's when that comes into play into the formula. So And of course, once you're done doing this, is one of the action steps you really need to make sure is that look at your established procedures to calculate the compensated absences and make sure you're revising them to reflect the correct approach, and make sure that everybody who's doing the math understands this. Because again, if you make the change, that's fine, but if it's not communicated and people aren't actually going to be aware of how to fix this, you're going to run into this problem in future years, and it's just going to keep snowballing and snowballing. You're going to keep dealing with this headache. So, okay, next issue is salary-related payments. Just a nice little tee off into what I was talking about. The salary-related payments were missing in the compensated absences liability. Very typically, we're dealing with amounts dealing with Medicare and Social Security. And again, a couple of possibilities of why this could happen. One, just not being aware that you have to include those salary-related payments that are directly and incrementally associated with the leave, per paragraph 23, as you see on the slide. Another one is just inaccurate calculations when you're applying the old guidance with Statement 16. The reason is because in Statement 16, salary-related payments, those were there. This is an opportunity to pick up those things perhaps in prior years if you weren't including it. So nice little opportunity to maybe fix an error, maybe not be necessarily material, but you can fix the error. So now how do you fix the scenario when it comes to doing your salary-related payments? So again, identify your related population payment population that are direct and incremental to the benefit. Typically, again, Medicare and Social Security, and it's typically a percentage of that gross pay. So, and then making sure that any defined benefit post-employment payments, such as your employer contributions, is not included in the payment population, and then doing the math as well. So the payment, your pay rate liability that we previously calculated, and you multiply it by that salary-related payment percentage. And it's usually a pretty safe way of doing that calculation, fixing it. Again, though, make sure that you are communicating the changes in your procedures to your stakeholders to make sure it doesn't happen again. Okay, next area is dealing with improper estimates, maybe because if you have multiple union contracts. And the issue is using a singular approach across all your departments to calculate your comp apps liability when there's clear differences at the department level regarding the amounts that are carried forward, the amounts that are going to be used, the amounts that are going to be earned. Again, and the problem is that, clearly you have a situation where you have inadequate understanding of your types of benefits offered versus the classes of the department employees. So, and GASB 101 paragraph 12, talks about when it comes to settlement, it looks at making sure that you are looking at your existing policies and understanding it. So it's actually in the standards to actually making sure you understand what's going on to do the calculation correctly. To fix this thing, the first thing is one, it kind of goes back to your days of when you were implementing the standard, is determine the complete population of your benefits offered, and then the degree of diversification among your employees. Really having a good inventory of your applicable policies and union contracts should be maintained in the finance department, and then coordination among the various departments. So let's say if you are decentralized and who's tracking your compensated absence, say the fire department is maintaining their own spreadsheets, police departments maintaining their own spreadsheets or systems or whatever the case may be, it's important to make sure that it's critical to make sure you have a good understanding of who's doing what those benefits are, and you're capturing all the data. And then performing an annual update of those benefits available, because the fact that, union contracts, they get updated, they could get modified, making sure that you've got the most current information. And it really must make sure it's reflecting in the upcoming year-end compensated absence liability calculations. So, and again, that reminder is making sure that it's reflected in your policies and procedures to make sure that you're calculating it correctly. So once you have identified all of these items and just making sure you've got everything, and then you diversify your calculations based on your population, that kind of moves into perhaps our last, for this session, example of common issues, and that's going to be missing disclosures. In this particular case, the issue that I specifically cited is your missing disclosure of what compensated absences in the debt roll forward footnote, and include missing the disclosure that a net increase or decrease was used. That's a change under GASB 101. Before, if you had your compensated absences balance. In the debt roll forward, you had to show your beginning balance, your additions, your deletions, your ending balance. And that tied into all the other calculations that showed up in the government-wide statements or the proprietary fund statements. Well, paragraph 30 of GASB 101 specifically said, hey, guess what? You don't necessarily need to show a gross. You can show a net increase or a net decrease, but you need to disclose specifically that it's a net disclosure. So you're alerting the reader so they're not looking for information. So occasionally I have seen this one missed. Fortunately, the fix on that is not a terribly difficult fix here. Really, it's just a matter of just reviewing the footnote disclosure from the prior year to determine, well, what did you do? Did you show it gross? Did you show it net? And then just tweaking that footnote for appropriately, including adding that additional disclosure. It doesn't have to be anything crazy, just a sentence, but making sure that it's out there and alerts the reader of what's happening. Okay, let's pivot now into GASB statements 87 and 96. Now, I know we've all dealt with the implementation of these particular standards, and really it's not necessarily an issue of incorrect calculations because you've implementing the standard. It's really what's happening now in the marketplace, and we're dealing with on occasion just new leases and new subitas. So that standards, it's pretty clear that, as far as how you deal with that, how you calculate it, how you record it as well. What we're talking about in the common areas here is dealing specifically with maybe contract modifications, because that is happening in the marketplace. Is that we're dealing with, let's say there was some changes to the lease term or the payment structure. Or something happened where perhaps the term of the lease is going to change because of extensions, whether it's going to be reasonably certain that these will be exercised or terminated, and then or an incorrect assessment when you're going through the calculations about what's the cancelable and non-cancelable portions of the agreement as well. Now, for the GASB 87, we're going to talk specifically in these examples only about the lessee side and the liabilities for the lease. We're not going to look at the ROU assets. And the reason why we're going to narrow that is because that's the one we're most commonly seeing. And two, the accounting for this and the disclosures for this are very similar to what we have in GASB 96. So we're going to look at these kind of in a nutshell together. So all right, so GASB 8796, first one is we'll take a look at a scenario where you have an agreement. It has been modified, the terms of the lease and the payment structure, but then the entity is not accounting for this as a modified agreement. You're just following the initial math you did under the lease and the subita under the original agreement language. We're also going to assume here is that this modification is not providing an additional asset, a right of use asset, for the lessee or the subita holder is in this case, because if that's the case under both of these standards, it's very specific. You treat those as a separate lease or a separate subita. So, and really what's happening is, again, it's just inadequate monitoring of your contracts and understanding what's going on. This is a challenge also especially when we were implementing the standard of because the fact these contract populations are in different departments, well, that continual monitoring of contracts, again, this is not a standard that you implement it and put it down. You have to keep monitoring what's going on, make sure the accounting on a prospective basis is accurate. And again, these are the citations we've got in here talking about how you deal with a modification which requires remeasurement of that lease liability, potentially also looking at the discount rate change per statement for paragraph 27. And I included the paragraphs in GASB statement 96 because the language in that is very, very similar. So the first case, how do you fix this? So you've identified, first things first, is you got to look at the point where the agreement modification took place. What was the specific point in time when that happened? And when you look at that modification date, then you look at remeasuring that lease or subita liability as of the point of that modification. And if the modification occurred in a prior reporting period, you're going to have to remeasure at that point, but determine if that impact would be an immaterial adjustment prospectively, or is this requires a restatement because the fact that we have a correction of an error. The scenario, remember, we're looking at where the modification occurred, but the accounting didn't get updated. So that's the error that you have to think about. So, and again, you potentially have to update that discount rate for remeasuring your liability as well. So again, take a look at the standard and make sure you're paying attention to that as well. And you also need to make sure is that you're updating your relevant lease and subita accounting policies and procedures for monitoring of existing agreements. We have, when you think about the audit side of this, and when you're auditing this, not only do you have to think about, okay, well, if you have an internal control, I mean, this is an internal control to make sure that the financial statements are calculated correctly. Well, if this error occurred and something was missed, well, clearly the design of said control is not designed properly because this got missed. So you have to go back, look at your controls and your procedures and say, what do we need to change to make sure that this doesn't happen again? Now, the next scenario we're going to run through is looking at the expiration of a lease in a subsequent reporting period. So we have a lease in our current reporting period. The lease is going to expire in a subsequent reporting period. So, and then during our initial assessment, there are extension periods that initially we said that we think it's reasonably certain it's going to be exercised. So we included that as part of the calculation of the lease liability. So it goes beyond our fiscal year, right? But now we've got factors that are happening that suggest that that extension is not going to be exercised, meaning that when the agreement runs out in the next fiscal year, that extension period is not going to be used. So that calculation of the liability and how long you're going to have to pay that off, that's going to change because the fact that, again, the term of the lease is going to be changed based on this. And this can happen in these assessments as well. We're also assuming that the agreement was not terminated per se. This is just the normal course of operations. So again, the problem is that we had an inadequate monitoring of our contract too, specifically. So I included in here the GASB 87 paragraphs between 12 and 15 that talks about how you look at the lease term specifically for those. If you have the lessee has the option to extend that's reasonably certain to be exercised, or a termination that's reasonably certain not to be exercised. And then again, if the lease term is going to be reassessed, if the option to extend that was previously reasonably certain to be exercised and it wasn't. So that's the scenario we're looking at here. And the fix, what do we do to fix this is one, again, kind of go back with the other issue, is go back to the point of time where the extension to termination changed. Now that's more than likely going to be within your fiscal year, probably not going to be that far back. It could be, but for this scenario, we're saying no, it's not. And then identify the point, and the extension date for the agreement would be used since it occurred prior to the termination of the agreement, because 3 months prior to that agreement termination is the example of when this lessee was required to exercise, to say, yes, in 3 months, we understand the lease is up and we're going to exercise it. So we reasonably certain, that's why it was reasonably certain to be exercised. That's why originally it was part of the lease term. Now it's not. Now we have to remeasure our lease liability using the modified lease term and the fact that we're going to pay this lease off a lot shorter now. And also those payment structures is going to be different because maybe the fee, the costs that were being incorporated in the debt service schedule for that extended period of time, well, no, they're not. You have to readjust it going forward as of that modification time. Again, common reoccurring theme, looking at your policies and procedures to make sure you're monitoring for agreements for modifications within those agreements as well. Okay, now this one is a scenario where the lease term initially was incorrectly determined because of the fact that there was some confusion on the cancelable portions, on whether it was truly cancelable or who was not cancelable, and essentially not really understanding who has the rights to terminate the lease. Again, Statement 87, Para 12 talks about, a period where both the lessee and the lessor, you can terminate without permission. If that's the case, if they can both do it without permission, it's a cancelable period. That is not within the lease liability calculation for the term. GASB 96 has very similar language to that as well. So what are we doing here? Again, you're going to have to go back to the agreement. In this case, since it was done incorrectly initially, you have to go back to when you started, and then you're going to have to recompute that calculation. And this one is going to be clearly a correction of an error under GASB 100 as well. And then consider whether or not, you know, your controls and procedures over that initial calculation, what went wrong? What was that root cause for that scenario? And then how do we fix that going forward? Okay, so we've got about 20 minutes left. So Anthony, if you want to take us in for our next little, well, I guess we call a hodgepodge of topics.
Hodgepodge, potpourri, whatever you want to call it here, right? These are various things that that we see in practice that oftentimes have components that aren't considered, or some inconsistency in practice here. So wanted to call some of these out and provide some additional guidance for you on this, and just kind of some of these particular topics here. So the first one is probably one that you've heard before, related to the net investment in capital assets. So the net investment in capital assets, if we're able to go to the next slide there, thank you. So if net investment in capital assets, oftentimes the calculation is looked at in its simplest sense, and there are components to this calculation that regularly are overlooked. Now, if you've again sat through GFOA's annual gap update or attended the annual conference and the common deficiencies that they see in practice related to this calculation, this is an every year topic that they bring up here. Generally, what we see here is that there's information that's missing from the calculation. So the easy parts of the calculation, taking our capital asset balances, subtracting out any debt issued to to fund or to acquire or construct those capital assets. Part one. What's often not included or excluded unintentionally there, if we have a deferred amount on refunding related to capital related debt, for example. So if you issued debt to refund previously issued debt, you have a charge on refunding or a deferred amount on refunding there, and it was related to capital debt, then that has to be factored in to your net investment in capital assets calculation. Same thing if you have accounts payable or retainage payable related to those capital acquisitions as well. And then finally, if you have leases or SPIDAs, Matt just talked about some of the reporting issues that we've seen related to leases and SPIDAs specifically, but as part of that as well, those need to be included as part of that net investment in capital assets calculation as well, because in effect they are, from a lessee standpoint or a SPIDA standpoint, that is debt in the form of debt issued to, again, acquire those capital assets there. Now, we can have the other side of the equation here too, where there are amounts that are getting included that are really not subject to that calculation there. Accrued interest payable from time to time we see, again, included in that calculation when it shouldn't be part of that calculation. So how do you do this calculation? How do you get it right? How do you make sure that you have the correct components incorporated, the right pieces included for that there? Variety of different ways to do that. Looking at the GFOA disclosure checklist is one route. GFOA actually also created a separate net investment and capital assets template that's available for download on their website as well. Strongly encourage you to take a look at those, double checking, making sure that your net investment and capital asset calculations are being done properly there. You're considering all of the required components for that. Now, we're going to keep kind of with the same theme here with accounts payable and retainage payable here, because oftentimes on the statement of cash flows in the proprietary funds that we see these calculated in error for that. So often capital assets and the associated AP and retainage payable with those, we look at that change in accounting or a change in accounts payable or change in retainage payable, that often just gets rolled into the operating activities. Well, what we need to do from a cash flow standpoint there is break out the portion of the accounts payable and retainage payable that is capital related, and then the non-capital portion as well. The non-capital portion is going to be in that top operating activities section, our payments to suppliers, and it's going to flow through as part of that number. Whereas any amounts related to capital assets is going to should flow through that purchases of capital assets line on on the right side there on the diagram for that. So that purchases of capital assets. And again, remembering that you're not just looking at the activity and the capital accounts payable or retainage payable in the current year, but it's the change in those amounts there. Now, obviously, you'll need to also impact your schedule on the reconciling amounts for the change in that those payable amounts at the bottom to not include those capital AP and retainage amounts there as well, but ensuring that capital transactions end up in the capital section of your cash flows, operating transactions end up in the operating section of your cash flows. Again, just being mindful of how those flow through there. Now, one of the items I noted that we have, where we see some, again, inconsistencies on from a reporting standpoint are, when we look at how things are classified throughout the financial statement. So one of the basic questions that, when you go through, if you've completed the disclosure checklist for a report, there is, do amounts articulate between various spots in the financial statements? We know in the governmental world that financial statements are large documents there. There's a lot of things that, again, interplay off of each other and flow from the back of the report schedules to the front of the report schedules there. So making sure that you have figures that are articulating as part of that process as well is part of that responsibility when you're issuing your financial statements. So a couple of the things that we'll go through, and we'll go through here looking at the sample ACFR that GFOA has available on their website for you here, but making sure that we're being consistent with how things are reported from an operating or capital grant standpoint as it relates to our enterprise funds, as well as looking at the governmental funds and statement of activities for consistency between those amounts there. So as we migrate over and look at the sample ACFR here, we've got the link included in the materials for you. But as we look at this here, this is the page, this is what it will come up to for you here when you open up the GFOA, and Appendix D is where they store their illustrative annual comprehensive financial report. Just as a general word of wisdom or reference here for you, if you're looking for an example at any particular point in time, and maybe it's a new note disclosure or something that you need to add to your financial statements, certainly feel free to start here. It's a great starting point to look and determine, hey, what's an example of this note look like here, so we can incorporate that into the financials. We're going to start by looking at the statement of activities. The statement of activities here, and what we want to make sure that we're doing when we look at the statement of activities here is starting off in our charges for services categorization there. So under our program revenues, if we can zoom in just a little bit more on that particular section, Matt, if you're able to. So within our program revenues here, we have our charges for services, our operating grants and contributions, and then our capital grants and contributions here. So charges for services, as we look at those amounts there, particularly as we think about it from the income statement on the governmental fund standpoint there, items that are charges for services on that schedule, we should be able to see and identify that those charges for services are in agreement between those respective schedules there. That, again, that articulation concept that we look at when it comes to the amounts flowing from the statements that roll into the statement of activities for this example here. Same thing for our water and transit activities, or our business type activities in this example here. Now, it's not just the charges for services or grants or those amounts there, but it's also looking at our general revenue section as well. So if we look at the general revenue section of the statement of activities, our various amounts that we report as taxes, if we have unrestricted intergovernmental receipts or investment income, things of that nature there, miscellaneous things, those all, again, you should be able to have an understanding of how those amounts are being pulled and how the articulation works between whether it be the governmental funds, statement of revenues, expenditures, and changes in fund balance, or the proprietary fund, statement of revenues, expenses, and changes in net position. So as we look here for property taxes, for example, we've got 45,060,105. In theory, and we'll see if this holds true there or not, but let's go to the governmental funds income statement here. All right, so in this case, there's a difference, and looking at that. So, right, so this is something that you'd want to be able to understand if there's a difference there. why is there a difference in terms of what you're looking at there? What is flowing into it there? Is something maybe rolling into the statement of activities number where something is being combined with that? There could be a variety of things that goes into that, or how things are being classified out of there as well. But again, that articulation piece here, again, something that you should strive to ensure that, if you have taxes that are looking at those amounts, there are other amounts that are flowing into that there. Again, absent a compelling reason otherwise, you should be able to see those amounts tie from, from one schedule to the next there as well. Another great tip as you're looking at this schedule and the statement of activities would be to look at just the total revenues, and adding up the total revenues on your statement of activities, comparing it to your total revenues on your total governmental funds there. Now, occasionally you may have amounts that differ as part of that from a conversion standpoint here. So if we were to look at the next page, Matt, I didn't ask for that page earlier, so I apologize here. But revenue recognition here may provide some of the the differences here between going from your governmental fund statement to your statement of activities there. So there could be other amounts that are related to that there. So we see earned but unavailable property taxes that in this case will likely be being recognized on the statement of activities versus those amounts that are shown on the governmental fund statement there. So very likely what's causing that difference there, being able to do that, whether or not you present that in a manner that is, you can determine how you're going to present that in a way that hopefully makes that something that you can easily tie back to your various schedules there. So if we go to the proprietary fund statement, statement of revenues, expenses, and changes in net position here, we're also going to look here and verify again operating revenues. Those amounts should be agreeing to our statement of activities, looking at those amounts to tie those out. Also being aware of how grants are treated here, right? Making sure that if we have amounts that are reported from a grant standpoint here, that those are being presented in that manner here. Now, this is going to get a little bit more complicated under GASB Statement 103 with the introduction of the subsidy classification there. But again, do it with that articulation in mind as you're being able to do that. So put yourself in the shoes of a financial statement reader to be able to ensure that you can move from one schedule to the next and be able to understand how those amounts are populating within your financial statements. One of the required disclosures under GASB Statement 67 and 68 relates to presentation and an aggregation of information related to certain pension disclosures here. So in this case, the entity that we're looking at here has a proportionate share plan as well as their police and firefighters pension plan. If there are amounts related to their pension liabilities and related deferred inflows or deferred outflows of resources there, as well as their pension expense, there is a requirement under the standard to present this information essentially in this format here, aggregating that information. Now, again, this is really summary information that is going to follow most often directly after this table in the respective notes as it relates to those pension plans themselves there. But again, it is a requirement within the standard there. GFOA has commented that that is something that they are looking for and expecting to see as part of that as well. Next, I want to just highlight for you here one additional tool that you can reference if you're looking at guidance or you're looking for particular information from a standard here. The Governmental Accounting Research System, or GARS, is a free site available from the GASB here. We've included the link there as well. If you go through the login, basically all you have to do there is kind of verify that you're not a computer and mining the data for your own personal use on that there. But on the left-hand side there, you have the ability to see that you can search, whether it be through the codification, if you're looking for information, particularly from an original pronouncement. The comprehensive implementation guide is referenced there as well. A great resource if you are looking for specific information or researching a particular standard on that there. So something that I have bookmarked, I know many of our team have bookmarked as a resource that we can pull from there as well, just as a reference point to ensure that we have the correct information within our files. Finally, the last item for today that we wanted just to highlight and cover for you from a reporting standpoint here Budget versus actual presentations, required for the general fund and major special revenue funds. And then if you present an ACFR, oftentimes we'll see a detailed presentation of budget versus actual schedules for your non-major funds as well there. When you have those presentations there, ensure that you have the level of detail that is necessary to demonstrate legal compliance. Make sure that your variance column calculations are done correctly as part of that. This is also going to have GASB 103 implications and GASB 103 effects on this as well in terms of what's required from that budget versus actual standpoint there. So familiarize yourself with that, but make sure that you're looking at that. And then finally, when you have, if you present on a non-GAAP basis or non-GAAP presentations there, if you're in a non-GAAP presentation and you're reporting under an other comprehensive basis of accounting, guess what? You don't have RSI because RSI doesn't exist under non-GAAP presentation. RSI is a GAAP concept there. So just making sure that you are labeling that information correctly as part of that process as well. With that, we're ready to launch our third and final polling question of the day. Our third and final poll question of the day, GASB 61 focuses on the nature of the primary government and component unit relationship to determine inclusion in the report. We'll give you a few moments here to get your votes in here. Component unit reporting is one of those fun GASB standards where GARS really comes in handy too, because they've issued no less than probably 4 to 5 different standards that have really talked about GASB component unit, the component unit relationship, whether it be 61, whether it be 39, even going back to 14. Yeah, I mean, you can go way back. lots of components there, but let's get about 92% of our vote in here. So 222 of our participants today, 86% of our group responded true. That is part of that assessment as well. So you're absolutely correct there. So you do look at that relationship there to determine that as part of the calculation and looking at whether or not something does meet a component unit calculation there. You can go through all the process from a component unit standpoint and determine whether or not that is there. Since we have just a minute or two, Matt, I don't think we have any questions that have come in here. Maybe we'll just briefly show folks the component unit section on GARS if we have that available here. The question often comes up is, well, do I have a component? And if I do have a component unit here, how should I classify it here? So again, this is directly from the GARS website here, from the original pronouncements, going to statement 61 here, and then getting into the illustrative examples here. For the sake of time today, I won't go through this in detail, but these are the questions you can ask yourself here. You're going to start off in that top left corner asking whether or not you have a legally separate entity or a legally separate potential component unit there. Depending on how you answer that question and the subsequent questions there, you're going to ultimately come to one of 3 conclusions. You're going to come to the conclusion that it's not part of the reporting entity, it's not part of the primary government, you don't have to worry about reporting it. Oftentimes that's I think that for many folks, the desired result there. You can come to a situation or a conclusion where that amount or that particular potential component unit, or PCU as it's referred to here in the standard, that is you can have that end as a discretely presented component unit, or you can have that presented as a blended component unit there. So we did have one question that I see in the chat here. So it says, for the change in major funds, is the ghost column only required if you identify a major fund in the prior year which should not have been a major fund? So a change in opening balance based on a prior period error, or is this just saying if the major fund in the prior year that is no longer major? It's the latter. It is the, as you look at, if a fund simply just changes from a quantitative standpoint there, that ghost column is going to be required depending on whether it's going from major to non-major or non-major to major, will really dictate where that ghost column exists. You could have a situation where you have a ghost column if you have funds that switch. If you have a special revenue fund that switched to non-major and a capital projects fund that moved to major there, you might have ghost columns showing up on both your governmental funds statement and your basic financial statements, as well as your combining statements in the back of the report there as well. So it is not restricted or limited only to from an error standpoint there as well. So great question in terms of that. So with that, I know we're just up against as I said, that time changed over to 1 o'clock here. It's 1 o'clock Central Time. So with that concludes our Yellowbook session for today. Hopefully you found this information to be helpful. Look forward to seeing you at next month's session and continuing sessions throughout the course of the year in our Yellowbook series here. Again, Matt and I's contact information is included for you within the presentation deck there. Thank you for your attention. Thank you for your time, and look forward to seeing you next month. Thanks, everyone.